So, the stock market. You hear that phrase, and what probably comes to mind? Crazy charts, huge numbers, and all these wild stories about people making and losing a fortune. It can feel, well, super intimidating. It's easy to just think, where would I even begin?
And usually it all gets boiled down to this one simple question, right? Is the stock market some kind of get-rich-quick scheme, or is it just a massive, risky casino? Well, the truth, as we're about to find out, is way more interesting and honestly way more empowering than either of those.
So that's what we're going to do right now. We are going to cut through all the jargon, all the noise. Our goal here is simple: to make the Indian stock market so straightforward you'll walk away feeling totally confident about how to start your own journey.
All right, let's start at square one. Before we can even talk about buying or selling anything, we need to get a handle on the world we're about to step into. So, what is a stock market, really? Honestly, the basic idea is probably a lot simpler than you think. Just picture a vegetable market, okay? You've got farmers, they bring their vegetables, and the price, well, that's just set by how many people want to buy versus how much is available. The stock market works on the exact same principle. Here, companies are the farmers, and their shares are the vegetables. It's just a huge marketplace where little tiny pieces of companies are bought and sold every day.
So when we say share, what do we actually mean? It's just a small piece of ownership, for real. When you buy one share of, say, Infosys, you literally own a tiny, tiny fraction of that entire business. And what that means is, if Infosys does well and grows, the value of your little piece grows right along with it.
Okay, so we've got the what. Now let's meet the who. Who are the main players in this world? The guardians and the giants that make this whole system tick.
First, you gotta know, the Indian market is not some new thing. It's got a long, incredible history. It literally started way back in 1875 with a bunch of brokers gathering under a banyan tree. That's how the Bombay Stock Exchange was born. Then, you had a huge leap forward in 1992 with the launch of the modern, all-digital National Stock Exchange. And today, India's market is one of the top 5 biggest in the entire world.
So, these are the two big pillars you'll hear about all the time, the BSE and the NSE. The main thing to remember is their index. Think of an index like a report card for the whole market. The BSE's Sensex tracks the top 30 companies, while the NSE's Nifty 50 tracks the top 50. So if you ever hear someone say the Nifty is up today, all it means is that, generally, India's biggest companies had a pretty good day. Simple as that.
Now, who makes sure nobody's cheating? That's SEBI, the Securities and Exchange Board of India. You can think of them as the official referee, or the market's watchdog. Their entire job is to protect regular investors like us, make sure everyone plays by the rules, and keep the whole system fair and trustworthy.
So who's actually in there buying and selling every day? Well, it's pretty much 3 main groups. You've got retail investors, that's you and me. Then you have domestic institutions like big Indian banks and mutual funds. And finally, you have foreign institutions. Now, these global funds, they have a huge impact. When they pour money into India, the market tends to go up. When they pull money out, it often goes down. Okay, so we know the what and the who. Now for the really important part. How do you actually get in on the action? Let's get your toolkit ready for this adventure. You really just need 3 things, and honestly, they usually come all bundled together. First, a Demat account. Think of it like a digital locker where your shares are stored safely. Second, a trading account. That's the tool you use to actually hit the buy or sell button. And third, a broker. That's the company like a Zerodha or Grow that gives you the app or website to do all this. And the actual process? I'm not kidding. It's almost as easy as ordering something online. You open your account, you add some money from your bank, you search for the company you're interested in, and you click buy. That's it. The shares are just electronic records, and they pop up safely in your Demat account.
So this brings us to the billion-dollar question that every single beginner asks: why on earth do these prices go up one day and down the next? Let's break down the forces that are really pulling the strings.
At its very heart, it all comes down to the most basic rule of economics you ever learned: demand and supply. That's it. If more people want to buy a share than sell it, the price has to go up. And if more people are trying to sell than buy, the price goes down. Every single price change you see is driven by that simple imbalance.
Okay, but what drives that demand and supply? Well, it's a mix of hard facts and, human feelings. Of course, a company's profits are number one, But so are big government policy changes, global events like oil prices or wars, and yeah, even raw human emotions like greed and fear. They play a huge role.
And that brings us to this legendary quote from Warren Buffett. It just perfectly nails the mindset you need to have, and it's the perfect bridge to our next really important idea, the two totally different ways people approach this game. See, you can be an investor or you can be a trader. Investing is about playing the long game. It's about buying a piece of a great business and holding on for years, letting it grow. The classic Infosys story is a perfect example. A small investment back in '93 is worth crores today. Trading, on the other hand, is short-term. It's trying to make quick cash from daily price swings. It's super high risk, super high stress, and frankly, it's not where beginners should start. For anyone new, the path of patient investing is almost always the smarter, safer bet.
So let's put all this together. Let's build your personal roadmap, your plan for starting this journey the smart way and the safe way.
First things first, let's be totally honest about the risks, because they are very real. Markets can and do crash. Good companies can have bad years, and our own emotions can trick us into panic selling at the absolute worst time. So this brings us to rule number 1, the most important rule of all. Never, ever invest money you can't afford to lose. Period.
With that golden rule in mind, here is your 5-step plan. It's super simple. 1. Keep learning what you're doing right now. 2. Open that Demat account. 3. Start small. I mean it. Even 500 or 1,000 rupees is a perfect start. 4. And this is crucial, diversify. Don't put all your eggs in one basket. And 5, the most important one, think in years, not in days. Patience is your absolute superpower.
And finally, let me leave you with a few golden tips to take with you. Please, don't treat this like a casino. Do your own homework and ignore those random hot tips you see online. A great place to start is with index funds or big, stable blue-chip companies. And never, ever forget the magic of compounding. That's when your money starts earning its own money over time. It's incredible.
So let's circle all the way back to our original question. A get-rich-quick scheme? A risky gamble? No, it's neither. The stock market is an incredibly powerful tool for building wealth over time, but it's a tool that runs on patience and a commitment to keep on learning.
We've demystified the what, the who, and the how. Every journey to building wealth, it doesn't start with some giant, risky leap. It starts with a single, informed step. So the only question left really is, are you ready to take yours?